Thank you very much indeed, Reese, and thank you very much indeed, everyone here and also joining online at home and wherever you may be. It's actually really nice to be doing this talk within the White Collar Factory because I'm one of the people who actually works from here, and it's an amazing space, and I'm very grateful to everyone who works here and to the office group as well for hosting us this afternoon. One thing I need to say at the very beginning is, although I'm going to be talking about tax, this is not tax advice. It needs to come with a big caveat in exactly the same way that you wouldn't be trusting YouTube for a medical diagnosis. Well, you shouldn't be trusting YouTube for a medical diagnosis. Then what I'm going to be saying over the course of the next half hour, 40 minutes, is going to be information, a little bit of entertainment, rather than formal tax advice. And of course, all the caveats apply to go with it. Now, for those people who came in this evening, you will notice that some people have got a pink dot at the bottom of your glass. And the reason is we're looking at 3 different ways that people can be taxed. You can see they've got 3 glasses on the screen here, and this broadly sort of reflects the 3 different ways. The glass in the middle is a full glass of white wine, and the glass on this side is a glass of red wine, and it looks like a full glass of red wine. But what you'll notice is this is actually a slightly smaller glass. And that's one example of how people are taxed, that something is taken away before they even realize that they've had tax applied right at the very beginning. This effectively is a slightly smaller glass of wine than the next one, which is a full glass of wine. Now, the middle glass here is a glass of white wine. Imagine someone pours you a glass of white wine and says, look, I've just put a little bit too much in, need to take a little bit out. Well, you might think that's a little bit odd, but you will probably be absolutely fine with it. You haven't drunk it yet. They take a little bit out, and you end up with your full measure, whatever you end up with being. Now, the worst form is this one, where you're given a full glass of white wine, you drink it, and the people who might have a pink spot on the bottom of their glasses are in exactly this position. They drink the glass of white wine, they finished it, and then someone says, well, you've now drunk that wine, we want some of that wine back. That is the way that we actually tax a lot of people in this country. Self-employed people effectively earn during the course of the year, and then many months afterwards, after they've quite often actually spent all the money, someone then says, well, actually, we want the tax on what you've actually earned. What we see in the middle here, where a little bit is taken out effectively as the wine is poured, well, that's the way that most people actually earn in terms of employment income. So tax is being taken out effectively on an ongoing basis. You get used to it, it's absolutely fine, and that's how that is. And the first one is actually something that tax authorities really, really like, and actually people like as well, because it's effectively an invisible form of tax. So far as you're concerned, you've got a full glass of wine. So far as the tax authority is concerned, the tax has been taken out effectively invisibly from you, and you don't even notice the way that actually happened. And that's the way that VAT and various other duties work in this country. And actually on that point, I want to talk about some of the changes that have come about as a result of the recent fuel crisis. You may have heard that the fuel duty rate, which is effectively a set amount of tax which is applied for every litre of fuel that you buy, has been reduced for the first time in over a decade by Chancellor Rishi Sunak. We'll meet him again in a little bit. Well, yes, he has reduced it, but the secret is he's still getting more tax than he ever was. And the reason is because he's got layer on layer on layer of different tax here. So if you go to the pumps, you buy a litre of fuel, you're paying not just the fuel duty, which is around about 55p, now being reduced down, but also you are going to be paying VAT. And VAT is 20% on the rate included effectively within that £1.60. So the more that fuel prices rise, the more tax is actually collected by the Chancellor, which gives the Exchequer more freedom to apparently lower tax rates. Well, is this a little bit of clever sophistry? Well, maybe it is, but actually one of the things that I hope I'm going to be getting across is that tax is all about the relationship between society and the government, and effectively it's one of the glues that actually holds us together, because taxes and our willingness to pay taxes are what enables us to be paying for things like healthcare, education, roads, rail, defence, especially at the moment, and everything else that might be needed. So, who am I? I'm Kevin. I'm from Untied. We're the UK's personal tax app. We believe that taxes should be fast, fair, and simple, that you shouldn't pay any more tax than you need to be paying, but actually it shouldn't be complicated. Most of our users don't need an accountant. They manage things on their own, and we include automatic optimization. So it would be unfair on all of our team that actually manage our marketing and comms if I didn't include a little bit of a plug for Untied. So with your permission, I'm just going to be pressing play on this video, which shows the Untied app.
So I'm going to give myself 90 seconds to show you how easy it is to manage your taxes with the Untied app. Our tax journey starts with open banking for both business and personal accounts. Here I've linked Barclays, NatWest and Revolut Euro. As I tag the first Revolut transaction, questions pre-populate and optimize that part of my return. I confirm I'm a freelance designer. Now it's converted the euro into sterling at the correct exchange rate and updated the income and tax calculation at the top of the screen. In due course, this data will come from the smart invoicing capability. As I tag an Amazon expense, we see it's found similar transactions, even though the references are different. I'll tag them all in one go. And now I can create a rule for the future. This is good if there's a regular supplier or if there is an account I always use for business. Scrolling down, an Insight light bulb against an electricity cost helps me claim some of my utility bills. A quick wizard apportions them automatically. As an added benefit, the app has automatically logged my journeys and the type of vehicle, claiming business mileage with a click of a button. I'll swap into last year and will file a return. Other income such as salary is also supported, and we have integrated into HMRC to push and pull data. I'll now submit. No need to enter my credentials. More than half of users in a sample didn't know their HMRC logins. And now real data is going to HMRC. They check the calculation and all being well will get a response. And here we have it. Tax in 90 seconds.
So that's a quick introduction to the Untied app. It's for people who need to file a self-assessment tax return in this country. That's 12 million people. And I've got news for you if you are someone who is self-employed or who is a property landlord, earning money by renting out property. Because from 2024, you will need to be reporting not just once a year, many months after the end of the tax year, but 4 times a year in year. It's something called Making Tax Digital for income tax. So if you are somebody who worries about the 31st of January tax filing deadline, which is what you have to do at the moment if you're self-employed or one of these categories, then you're going to be worrying 4 times a year. And you're going to be worrying still on that 5th occasion on the 31st of January because you're still going to have to do something on that date. So Untied exists to make it as easy and streamlined as possible for you to be submitting your self-assessment tax returns in that particular way. So on the subject then of taxes, I think the sad thing is people do care about taxes and they care about how they reduce the tax that they pay. And I think this is something where there's actually a bit of tension in society. Do we want to reduce the tax that we pay, or is it fair that actually we pay that little bit more? From our point of view, it's essential that we follow the rules, but don't pay any more, because the rules are set up in order to actually understand our position. So we've got to take advantage of those things that are there, and we'll look a little bit at the difference between tax avoidance and tax evasion. Very simply, tax evasion is illegal, tax avoidance is legal, but sometimes if it starts to get a little bit extreme, you do have to declare to HMRC if the structure becomes a little bit artificial, because they don't like things which really don't reflect the reality of things. So who should be paying tax? Well, it's an interesting question. Rishi Sunak is, of course, the Chancellor of the Exchequer. Do we care about his wife's tax position? And is it any of our concern what her personal financial affairs are? I think this is actually a really interesting thing, because tax is one of those few areas actually of public policy where there is a direct correlation between someone's relationship status and the tax that they're going to be paying. One of the most expensive things that you can be doing is get married, I'm told, but also one of the most tax efficient things that you can be doing is to get married, because there are lots of opportunities to be sharing reliefs and various other things into spousal, and that also extends then to other sorts of relationships. But what's interesting here about Mrs. Murty, or Ms. Murty, is her wealth is effectively generated in India. And I think one of the interesting questions from our point of view is it right that the UK starts to tax something where the wealth and the value has always been generated in India? I draw a contrast with certain other people who may be in the political realm, who have decided that they want to be non-dom. And what that means is they are starting to move from being in the UK, claiming that they've cut all ties with this country. And when you do that, then the way that you get taxed actually changes quite fundamentally. So for those of us in this room and those of us who are online who are UK resident, we are taxed based on our global annual income. If, on the other hand, we become non-domiciled, and domicile is effectively where your roots are. Initially, it starts with your father's domicile. But if we cut ties with this country, move elsewhere, and change our domicile, then we can be a non-dom. And a non-dom is only taxed on the money that they effectively remit to the UK, what they bring into this country. So that's the way that you would be taxed. And that's what she's been doing up to now. Now, there is a penalty. There's effectively a fee that you have to pay for that right. But she's been paying that. Of course, now she has changed her position. For those of you who came in and joined with a sort of slightly later glass of wine, we were looking at different ways that taxes actually can work. So a quick recap. The first one is you get a smaller glass. That's the way that VAT is effectively in this country. That tax is taken away, you get a smaller glass, you don't notice what's going on. And interestingly, this is called indirect tax because for VAT, it's collected by somebody else. It's collected by whoever is actually selling you that wine or the fuel or whatever it might be. The middle one is where you get a glass of wine and someone takes a little bit of wine out, and that is effectively like payroll tax. And this one is the worst one. This is for self-employed people who drink the wine, they're quite happy at the end of it, and then many months after, someone says, well, you've got an empty glass, can we have the tax afterwards? And of course, that's a miserable situation. But why do we get here? Well, one of the reasons is this. This is the ONS summary of how we spend our money. So on average, a typical household spends £80 a week on transport, nearly £80 on housing, food and non-alcoholic drinks, £60 a week or so. I can't see where the alcoholic drinks are, but it's ... But maybe that's because we don't like to declare exactly what it is. But what is absolutely astonishing is in this ONS set of statistics about where we're spending our money, there's no mention whatsoever of tax. And yet taxes are our single biggest area of household spend. Together, we are spending £300 billion a year on income tax. So if you were to look at this in terms of where we're actually spending our money, that works out at around about £200 per household per week. So that's more than transport and housing added together. So if you take transport, housing, clothing and internet and other things, that's how much money we're all spending on tax. And yet we don't talk about it. And this is why it's often overlooked. So let's go back. Let's go back around about 1900 years. This is in Chatsworth House. It's a relief. And it's a relief of Hadrian in Rome at the Trajan Arch. And what Hadrian identified was that when he took over, a lot of taxes were owed effectively to the Roman administration. As part of a grand political gesture, he did what other politicians do in order to get favour. He cancelled them. So all the money that was owed to Rome, Hadrian effectively said, look, we're going to cancel those debts, and then we will reset things. And that effectively is a relief, which is at Chatsworth House. And we'll see more from Chatsworth in a little bit of these debts being cancelled. I think all of this up here is effectively the ledgers, the notes of the tax that was being cancelled. But people always want to find ways to avoid taxes. I'm going to show you this picture. This is a house in Highgate. It's called Avalon. And you can see a lot of these windows are actually bricked up. For a significant period around Europe, there was something called the window tax. And the window tax was a way to measure the wealth or the size of a particular house. The more windows you had, the more tax effectively that you paid according to those windows. And it was only in the 19th century that these things actually disappeared and we moved on from window tax. But actually, sometimes you see something and you think it's a tax and it's not actually a tax at all. These particular fake windows were never there as fake because of window tax. They were actually there so the people who were living in this house couldn't see the poor people living in the almshouses opposite. So this is something where people think it is a window tax, but actually it's got nothing to do with it. On the other hand, this is George Washington. And you can see behind him, you can see 2 bricks. During the course of the American Wars of Independence, it was decided that there should be a brick tax. There was a tax on each individual brick that we're using to build a house. So these were the standard size bricks, and some entrepreneurial brickmaker said, well, hang on a minute, what I will do is I will make larger bricks, 2 or 3 times the size of a regular brick, and therefore the tax per brick was a lot lower. And this is a really good example of how taxes evolve, because there was an idea, well, a brick is a brick, let's tax that each one on a house. People come up with bigger bricks, and then of course the next level of legislation is we have to limit the brick sizes. So then there's all sorts of codes around the size of what is a brick in this particular country. Shortly after, this is the Battle of the Nile as part of the Napoleonic Wars. This is a really exciting opportunity in sort of to cover a little bit of tax history, because it covers 2 things. First of all, income taxes were introduced as a result of the costs of the Navy in particular through the Battle of the Nile. But equally, there was a loss of political goodwill amongst the people to pay these taxes. And that's a very important thing, because if people don't want to be paying the taxes, then it's very hard for the Exchequer to be raising them, you end up policing them, and you end up potentially with civil disobedience. So income taxes were first introduced here in 1799, and then afterwards they were meant to be a temporary measure, but they then came in full-time from 1842, and effectively forming the basis of the income tax that we have at the moment. But actually, when we earn, we pay not just income tax, we also pay national insurance. And national insurance is a brilliant way for a tax authority to be raising money. First of all, most people in this room know the rate of income tax, and my guess is very few people actually know the rate of national insurance. National insurance is also applied twice. So if you are somebody who is in this room or online who is employed, then when you earn money, you pay national insurance, and your employer also pays national insurance, which is a very convenient thing if you're Chancellor of the Exchequer or Boris Johnson trying to raise money to cover the NHS. You increase the rate of national insurance by 1.25%, but actually that's 1.25% of the employee and 1.25% of the employer, 2.5%, 2-for-1 offer, and he's managed to get that new tax in effectively at a lower rate. Of course, though, we don't all accept taxation. This is a women's suffrage movement, turn of the 20th century, and effectively suggesting that why should they be paying tax if there's no vote, and it's exactly the same thing, no taxation without representation. And more recently in this country, this is Trafalgar Square in 1990, when we had the poll tax riots. On the face of it, the poll tax felt very fair. Everyone pays the same amount. Well, doesn't that feel fair? Well, it doesn't if you're somebody who lives next to someone who's actually earning an awful lot more in a much bigger house and so on. And that's what resulted in the poll tax riot. And I just put that there because I quite like the poster that says stuff the toll tax up their asses. So, of course, not everything does get taxed in the same way. The sort of thing that authorities like to tax are the things where you're going to be making money. So perhaps it's no surprise that you don't pay tax on gambling winnings, because the reality is, if you're going to be making money by gambling, more people are going to be losing money by gambling. And one of the principles of tax generally is that you can offset your losses against other things that you're actually doing in the same year. So if we all go out and we lose all of our money on the roulette wheel, quite reasonably, the Exchequer doesn't want us offsetting that against the gains that we're making in other ways. Lots of interesting stuff about crypto at the moment, and things can be taxed in different ways. If you do something as a one-off, so if you buy a work of art and you keep it for 10 years and you sell it afterwards and it's gone up in value, well, you've made what's called a capital gain. And there's a tax called capital gains tax, which is on what you've just sold. Similarly, if you buy shares, there's a capital gain which you make if those shares go up, capital loss if those shares go down. Capital gains is actually a really, really efficient way to be earning money. And one of the interesting things is the Institute of Fiscal Studies does some really, really good work looking at how people pay tax according to what their income levels are. So in theory, we have a tax system where the more you earn, the higher the rate of tax is that you pay. So you start off paying no income tax effectively because there's something called a personal allowance. Your first £12,570, you're not paying any income tax. As you earn more, then the rate of tax increases. If you are someone who is earning between £100,000 and £125,000, then you are going to be squeezed. You're going to be squeezed with basically the highest rate of tax in Europe on every other pound that you're earning. It's potentially going to be more than 60%, but if it's student loan, then it may even be 70% that you're going to be paying as you're going. And the reason is, when you hit £100,000, your personal allowance, which was £12,570, is being reduced, and you're being taxed. So effectively, for every £2 that you earn, your personal allowance is falling, and you're being taxed on that. So you've got all this sort of double taxation coming in, and that's where you need to be doing a lot of planning. But coming back to capital gains and crypto, if you are someone who buys one piece of art or shares on a very occasional basis, they go up, they go down, you've got capital gains and losses. If you do this every single day, then it starts to transition from being a capital gain or capital loss into something which is trading. And the tax rates, if you're doing this on a trading basis, suddenly change from the capital gains tax rates, which are very attractive, into some of the income tax rates, which are significantly less attractive to you. Of course, we get taxed during our lifetime, but we also get taxed when we're dead. And what strikes me as very interesting is one of the least popular taxes is inheritance tax. That it should be one of the most equalizing ways to tax people in society, because we don't need the money, it's gone, we're gone, and everything else as well. But actually, people really do not like inheritance taxes. And you look at the amount of average tax paid, and it's significantly below what the official rate is. And there's all sorts of planning that goes on around inheritance tax. What I would say is if you do plan on, if you do think that you may need to be doing some inheritance tax planning, it's worth doing that several years ahead of the time, because there's lots of things that you could be doing in order to reduce your inheritance tax bill. We used to have something called death duties, and this is a tapestry called one of the Devonshire tapestries at Chatsworth again, and this was given effectively to the nation instead of paying death duties by the family around about 50, 60 years ago. So that's what that is. Right, let's bring things now into the present day, but we'll see one little tweak in a little bit about timing. What is striking about tax is what we think we get for our money isn't the same of what we actually get. So on the right-hand side, this is a survey that was done, it was before the EU referendum, and there's a particular reason for that. And it was also before COVID, because that sort of obviously throws all sorts of things as well. So this was back in 2014. YouGov did the survey. People think, or they thought, that we spent 7% of our overall budget on the EU. We actually spent 1%. They thought that 12% of all the money was going on health, but actually it was significantly more than that. It was 19%. They thought 12% was going to welfare, and actually that was 25%. So what's really interesting is what people think they're getting for their money is actually really quite different from what they are actually getting. And some of the things are just sort of really quite striking, sort of in the opposite direction. So debt interest, of course, people do talk about it, but they don't really think about it. But really, I think it's quite striking that government administration is something which is perceived to take 8% of the money. I'm not suggesting the government does everything efficiently, by the way. Let's not read that into that. But 2% actually of the total amount raised goes into government administration. I just think that is quite interesting. Subject of administration. Does anyone know who that is? That is Pope Gregory. So, this country took a little bit longer than the rest of Europe to move to the Gregorian calendar. We moved to the Gregorian calendar, which effectively managed all the adjustments around leap years. We moved in 1752. I think that Pope Gregory sort of came up with the calendar around about 170 years earlier, so around about 1582 or thereabouts. So actually, where we are now is 170 years since we adopted the Gregorian calendar, and it was 170 years from the rest of Europe before we actually did it. Anyway, so when the Gregorian calendar was adopted in this country, we lost 10 days. Like, the date shifted by 10 days in order to align with what we wanted. And the tax authorities were concerned that we were going to lose 10 days of tax. So as a result of that, the tax year was moved by 10 days, and it was moved from, this is going to be really, really screwy with people's minds, right? It was moved from the 25th of March to today, with a few adjustments. It now starts on the 6th of April. But it goes back to him. And the 26th of March, it was all down to religious quarter days. So the only quarter day that I really know from a religious point of view is Christmas Day, which is the 25th of December. But there are ones at similar points in March, June, September as well. And that's really sort of why we have our weird calendar in this country in terms of tax years. So, where does that leave us, and what does this mean in terms of you and your taxes? The most important thing I was going to say, sort of in terms of being able to do things to reduce your tax bill, is this, and it is to keep your records. Because one of the really difficult things is someone will come and say, I'm worried about my tax position, I've got these shares, they've gone up, and we'll say, well, how much did you pay for them, and when, and all sorts of other stuff, and if you don't have the records to hand, it's actually very hard to do sensible sort of planning around them. And one of the really peculiar things is, if you start to be self-employed, you need to register with HMRC once you start to turn over more than £1,000. But you don't need to register for many months after the end of the tax year. And what we find is that people wait until after the end of the tax year to register, but actually they're then going to go back and got records from before they were actually registered. So keep your records on an ongoing basis, and that's really going to help you. And if a plea, if you change bank accounts, download your statements beforehand in full. Because one of the really uncomfortable things is you close your Barclays account because you get all this great switching guarantee, and you open up your Monzo, and you go along, and then you realize you've lost all your records, and then you have to go to Barclays and they print it out. So you're given a whole load of paper, whereas really just download it beforehand in Excel and away you go. When it comes to tax reliefs, there are a couple of ways that you can be structuring yourselves. So imagine you're setting yourselves up. You start off by maybe selling second-hand records. But you're selling second-hand records, and you set up your own business. To begin with, you were doing it on your own account. It is you as what's called a sole trader, and you'll have to pay tax effectively if you're making a profit on top of things. You still have the personal allowance and various other things. Someone will tell you at some point you should set up a limited company. They may tell you on day one, why don't you set up a company? And the reason for that is a company is taxed on average at a lower rate than somebody who is self-employed on their own. And that's for two reasons. First of all, the rates actually are slightly lower. But second, you can also choose when to take the profit. So imagine you set up a company and you start selling lots of records and you're making profit within the company. That company has to pay corporation tax. You take what's called a dividend out of that company and you pay tax on that dividend. And you also will take a salary out of that company. And by working out the timing and working out the blend between them, it's possible to reduce the tax rates. Their advice from a tax point of view is absolutely right. But I would also caution, because the excitement about setting up a limited company is also giving you additional reporting obligations. And it's giving you additional risks. So if you fail to submit your accounts with Companies House, you fail to do your corporation tax return, you fail to do your annual compliance statement with Companies House, then suddenly you're getting yourself in a much, much more twisted position than if you're just trading on your own. And I would say until you get bigger, best thing to do is to remain self-employed. And you can be doing lots of stuff to offset that. A lot of the reliefs you have go back to here. So this is a Lancashire image of cotton mills, and the reliefs that you get for buying plant and machinery, so effectively equipment, are actually really attractive. So you go out, you buy your computers, you buy your phone, you buy all these other things. Well, you can be claiming the cost of all of these in one go. There's one thing, though, I would be really cautious about, because it's exciting to be claiming expenses. Some people think that claiming expenses is a bit of a myth, so that I'm going to go through two myths here. The first one is that people think that your expenses reduce your tax. Well, they do, but they actually think that if you pay £100 in expenses, that it reduces your tax bill by £100. It doesn't. It simply reduces your profit by £100 and you still pay tax on what's left. Logically, everyone knows that, but that's one of the first myths that sort of people say. The second myth is from time to time, I'm told that you don't pay tax in the first year. Well, you don't. But do you remember those wine glasses? You don't actually pay the tax in the following year, but it doesn't mean that no tax is due, because you do have to pay the tax eventually. So if you spent all the money, then you're not in a good position. But when you incur your costs, you want to be thinking about, do you remember I talked about the marginal rate, that if you're earning £100,000, £125,000, you're paying a really high marginal rate. So you need to know what your marginal rate is for every pound that you're earning and every pound that you're spending. So for most people who are self-employed, for every pound that they earn, they'll be paying around about 29% tax. But if you've got, particularly in the early years, a lot of cost, you might actually be earning under £12,500. And if you're earning under £12,500, you're paying no tax anyway. So adding more expenses is simply, it's not going to give you any tax relief because you're already paying no tax. Increasing expenses, you're still paying no tax. I'm going to move on to a couple of things now as we sort of start to look at some of the practical things you can do. A lot of this is actually about transforming one source of income into another. And we talked about setting up a limited company. And I'm just going to sort of quickly talk about this just because this is where I put the slide. The limited company legally is separated as a separate entity to you. But you might say, look, it's got nothing to do with me. But HMRC, of course, know that really deep down it does. And you might have heard of something called IR35. So IR35 is effectively a series of measures over the course of the last 20 years or so where HMRC have sought to change the legal identity of you as a separate entity, completely independent. It's a company. And no, I've got nothing to do with the company. I just happen to be an employee who takes £7,000 salary a year, and I happily do that. And transform that into something where they treat you as an employee. So if I am someone who's got my own company, I contract to a bank. So I go to HSBC and they say, we want to use your services, and I'm pretty much working there full time, then I will be taxed under IR35 effectively now as an employee. And the clever thing that HMRC have done over the course of the last few years is they used to go after me. Well, there are lots of me's to chase after, and to be honest, I might take the risk, as many celebrities have done, about what my position is. But what HMRC have done now is instead of going after me, they're going after the entity higher up. So they're going after HSBC, and they're going after the banks, and they're going after government departments that engage people this way. And quite rightly, these organisations are much more conservative about what that means in terms of their risk. So they're going to be more inclined to deem me to be someone who is an employee. I'm not sure many people have got one of these. Well, I mean, a tidy bedroom with a made bed. I'm not quite sure actually what that is hanging on there, but maybe that's a mask that they put on first thing in the morning. If you have a spare room and you have someone staying in your spare room, rent-a-room relief, you can get £7,000 or so of tax-free income that comes a year as a result of rent-a-room relief. Topping up your pension is probably the single best thing that you could be doing for your long-term financial well-being. Though this is not investment advice, this is not financial advice, this is not tax advice, but putting money into your pension gives you really good tax relief. Even if you are somebody who is not paying tax, the government will put some extra money into your pension, normally 25% on top of what you put in as a result of your contributions. But if you're somebody who's in one of these really, really squeezed positions, you can get very favourable treatment by putting money into your pension. One of the other things that you can be doing if you are approaching this £125,000 zone is you could talk to your employer about deferring your bonus potentially. You could talk to your employer about changing some of the benefits that you're getting. You may actually end up with a better mix on the top of it. If you have children and you're earning over £50,000, then there are different things that you can be doing in terms of child benefit and relief that you're getting there. And one other thing I actually also want to highlight is there are lots of opportunities to roll over gains. So if you are somebody who has got capital gains, then there are opportunities to reinvest, to do rollover, and effectively to defer your gains. Perhaps the most exciting opportunity, I think, in terms of people who are thinking about investing in early stage businesses is something called the Seed Enterprise Investment Scheme. SEIS and its slightly larger cousin, which is the Enterprise Investment Scheme, gives really, really positive tax status to investments that you make in it. To the point that if you lose your investment, there are actually certain points that even if the company goes under, there were points where people could still make money, even with the collapse of the company. But effectively what you get is you get tax back on the investment that you're actually making. What the gain that you make within it is also shielded from tax. And there are various other advantages. So that's a Seed Enterprise Investment Scheme. It's open to early stage companies, and it's open to the investors as well, who put money into that. And you can put as large or a small amount in, subject to certain limits, but you could start very small if you want to be doing this. Of course, every early stage company has significant risks as well. So what are the big catches? I've got to say one of them is simply missing the deadline. The deadline, if you're doing self-assessment, is the 31st of January. 1 million people miss it. They wake up on the 1st of February to a penalty of £100. So that is 1 million people who just could be avoiding that. And I've got to say, it is just as much stress doing your tax return on the 1st of February as it is doing it on the 1st of January. I would also say do it early. like, I know I'm a last-minute person. We all leave it to the last minute. But if you can do your tax return early, I'd strongly recommend it. And one of the reasons is you don't know how much you're going to pay until you've filed your tax return. And the deadline for paying is also the 31st of January. So if you file your tax return on the 31st of January, you haven't got enough time actually to be paying it. And then you're racking up all sorts of worries about that. I mean, strictly, you can pay a little bit later, but I wouldn't recommend doing that. As we sort of come close to sort of wrapping up sort of what we're talking about, I want to sort of just cover a couple of things. We talked about avoidance and we talked about evasion. And one of the things is this sort of line between what's fact and what's fake from a tax point of view. And there was a scheme a few years ago where there were very generous tax reliefs for people who were involved in making films. A lot of celebrities actually put a lot of money into this. And HMRC came after actually some of them and said, well, hang on a minute, this is not a real scheme. A little bit like the producers, I think some of these schemes may have actually been designed to be uncertain whether we're going to be profitable or whether we're going to be losing money. But actually, some of these schemes made highly profitable, successful films. So even if you're not quite sure at the beginning whether something is going to be a success, sometimes you can surprise yourself. And I guess that's the same with any investment. This is a ship called the world. And I think it's actually quite a sad ship. It was originally created as something called residency. And the project was to allow people who wanted to avoid tax to travel around the world with no tax residency whatsoever. It would simply go effectively as a tax haven on the oceans. And I think that if you're someone who has got the luxury of the wealth that you've generated, it behoves you as well to have responsibility to other people in society. And Alan Sugar, a few years ago, was criticised for not paying taxes. People who don't know Alan Sugar, he presents The Apprentice in this country, has had lots of investments in technology through property, and also owned Spurs Football Club at one point. But he, in response, took a photo of the cheque that he wrote to pay HMRC. And it was something like £57 million. I've got to say, if you've got £57 million, I still find it amazing that you have to use a cheque to pay it. But I guess we all have limits on online banking. But it really sort of actually is quite significant when people do say, yep, I am recognising my responsibilities to the rest of society. And there will be people for whom leaving this country, going elsewhere for a few years is tax efficient. But hopefully at some point they will come back. And this ship, the world, it still exists. But trying to sort of think about how you want to live your life, I think, is just as important as the tax mitigation for it. And meanwhile, I guess sort of for the rest of us, this is sort of perhaps how sometimes we do feel about tax. We're doing what we can to get where we want, but we're also aware that sometimes someone's got their eyes on us. And the best thing to be doing is to follow the rules and to be safe. Thank you very much.
Thank you so much.
Ladies and gentlemen, we are going to go to questions. Those of you join in online, if you have any questions, please then send them through to the chat. If anyone does have a question in the room, if you can just put your hand up and wait for the mic to come to you, just so those at home can also hear. So we'll go to questions now.
I'm just wondering about the customers of Untied, who your market is, who you're targeting, who are your customers and clients.
Thank you. Right. So the question was, tell us a bit about Untied, who are we targeting and who are we helping? We're really here with a suite of services to help people who have to do a tax return, and that's 12 million people. And out of those, you're going to have people who are higher earners, earning more than £100,000. You have to do a tax return if you're earning that through a salary, or more than £50,000 if you're receiving child benefit, and you have to have adjustments around that. We're also here to help people who are those who are earning through renting out property, and those who are self-employed. a significant number of people have become self-employed over the course of the last few years as a result of the rise in the platform economy. And one of the big shocks to me is when you look at the average earnings of someone who is self-employed. And I was looking at some stats, and it's sort of something like 50% or something that earn under £300 a week. So there is a significant number of people, these are newly self-employed people, who are earning quite low amounts of money. But they have the same obligation as everybody else to be doing a tax return once they're earning more than £1,000 a year. Traditionally, they would have used an accountant. So around about 50%, 51% of people use an accountant to do their tax filings. 49% have done it online with HMRC or using software. But I think going forward, there is actually less need for this to be done with an accountant, because software can actually do an awful lot. It can't do everything. And it can't do everything because of something called the IKEA paradox. And the IKEA paradox is all about the bully bookcase. So I don't know who in the room has got a bully bookcase. I think, are we allowed to put hands up? Yeah, okay, we've got nods and we've got hands and various other things. So if we all go and we buy bully bookcases, from our transaction, it all looks exactly the same. We've got an IKEA purchase of £80 or something, plus a load of plastic things that we didn't know we were going to be buying, but it's a bully bookcase that we've all bought. But I've bought it for my office. You've bought it to put into your living room. So for me, it's a business expense. For you, it's not. You've got a property that you're renting out. So you're putting that as a property expense. And you might be a builder, and you are effectively installing that in someone else's living room. So all of us have got exactly the same transaction, and the data can't tell us immediately what that is. So you do need to have input from the individual. But alongside propositions that we've got for people who are platform workers and self-employed, whether it's freelancers or whatever it might be, we also see the need for support for people who are using platforms to invest. So the wealth platforms, I think, are becoming a really important way that data needs to be aggregated in order to actually understand someone's tax position. And that's whether they're doing it themselves or whether they are looking for an advisor to help them. And we can be modeling effectively to tell them in advance the sort of tax that they're going to need to be paying. And importantly as well, to help people set tax aside at the time of that transaction. It all comes back to the wine glass. Because if I asked you now for some back from the wine that you finished, of course you don't have it. And I think one of the best things we can be doing for people's well-being is to make sure that they've got the tax set aside for when they need it.
Well, ladies and gentlemen, can we have a huge round of applause for Kevin, that phenomenal talk?